friends, welcome to this edition of IPO Review. I am Piyush Jain and you're watching it exclusively on ICICIdirect. Today, we are bringing to you a watch company, a company which is into luxury and premium watches. This company sells two types of watches. Number one, they're selling fresh watches. They buy from the manufacturers and then they sell it to the customers. Second, they are selling certified pre-owned watches. So all watches are into luxury and premium category. The IPO is opening up on May 18 and is closing on May 20. The company is raising about 472 CR from this IPO, out of which 375 CR will be fresh issuance of equity and about 97 CR will be sale of existing shares by the promoters. From the perspective of revenue and margins, what we have seen is the revenue growth has been 40 to 50% over FY21 numbers when we see the first 9 months of FY22, and also the margins have improved materially. Let's try and decode the business model and what the future holds for this company, and for that, let me welcome the management. Mr. Yashwardhan Sabu, the Managing Director, and Mr. Ritesh Agrawal, the Chief Financial Officer of Ethos Limited. Gentlemen, welcome to the show. Let's begin with you, Mr. Sabu. Help us understand the business model of the company. How does the company make money?
Hi, Piyush. Thanks very much for having us on the show. Glad to explain our business. As you mentioned, Ethos is in the business of retail of premium and luxury watches. Premium and luxury watches are growing rapidly and steadily across the world. And in India too, we have seen a strong growth current across the years. There was a bit of a between situation in 2016 and 17. After that, growth has been pretty steady. We have chain of retail stores, 50 stores across 17 cities. And this physical network is equally well supported by a very strong digital network. We have a strong website. It attracts 21 million plus visitors in 2021 calendar year. Very strong social media presence. So we connect with customers and people interested to buy premium and luxury watches digitally as well. And what we do is offer an omni-channel experience. So it is a customer can either discover watches on the net and go to stores and buy them. They can discover watches at the store and come to our internet site and buy them there. So it's really a seamless omni-channel platform offering luxury and premium watches, a fast-growing segment, as I mentioned. Typically, business also succeeds because not only is the demand growing, but our offering prices that we offer, MRPs in India, are comparable globally. There used to be a feeling in the past that watches in India, being after paying duty and so on, are going to be more expensive. That's basically not true. Prices are comparable. The range that we offer in terms of products and brands is very comparable. The service that we offer is comparable. So there is a strong business model serves customers who want these watches, and that's how we are seeing.
Well, let me come to you, Mr. Agrawal. We have seen sharp increase in the revenue compared to FY21 numbers for the first 9 months of FY22. Similar developments seen in margins. Margins have moved up. Help us understand how sustainable is this trend, and what are the reasons from a core business perspective.
Thanks, Piyush, for having us on the show. The growth trajectory in current year is basically the strategy that the company has taken over last couple of years pre-COVID. What we were doing is moving on to the higher price point segment as same as like the world globally that we are doing. Focusing on the customer service, as Mr. Sabu has mentioned about the omni-channel presence. So we have a very strong omni-channel presence, which actually we have learned during the COVID and we have made stronger over the period. So that actually helped, and that resulted in the Q1 result where we have reached Q1 of 2022, which was a Delta wave. Despite that, we have achieved 90% of our pre-COVID revenue. So that's the foundation that we have built over the year that has resulted the revenue acceleration during the FY22.
Piyush, if I may add a comment here, it's while it seems like it's a big acceleration, we have to remember that we are comparing 9 months of FY22 against 21, and 21 was deeply impacted by COVID. Uh, to get to a real underlying trend, we have to actually analyze quarter by quarter and remove the quarters that are COVID impacted. If you remove that, you will actually see quite a steady uh, across the last 12 to 14 quarters. And I think that's really important. Another question that I think you asked was about the certified pre-owned watches. I'll just quickly go through that. So the certified pre-owned watch is a business that is growing very rapidly globally already. Globally, the pre-owned watch business in the premium and luxury watch business is about 25% of the business of new watches, and it is expected to become 50% within the next 3 or 4 years. So the trend is that the business of pre-owned watches in the luxury field is going to be equal to that of the new watches. In India, it is still early days, but the business is growing rapidly. There's a report of Technopack, which suggests that the business of pre-owned watches, which was about 40 to 50 crores in FY 2020, may go up to 700 to 900 crores by FY 25. And that's a very rapid increase. We are first movers in this. We started 2 years ago, and we are first movers in this. We have a pan-India presence that allows us to buy pre-owned watches at an all-India level. We refurbish them, we certify them, and we sell them. And we're seeing an immense dynamism in the demand for pre-owned watches. As you will understand, pre-owned watches does two things. Number one, if I have older watches which I am no longer wearing and I want to trade them in for higher watches, I now have a market where I can get the best prices. On the other hand, if I want to buy a luxury watch at a relatively lower price, I can go in for a pre-owned watch which is certified in excellent condition and so on. And because of this, like all over the world, in India too, the pre-owned business is growing very rapidly.
Well, this sounds interesting and also impressive. Now, from a margin perspective, we are talking about two businesses here. One again is certified pre-owned watches, and the second one is a core fresh watches business. From the margin split, again between both the segments, how's the blended margin outlook looking like? And help us understand the margin profile for both the verticals separately.
Right. So in terms of margin, you're absolutely right. Let's talk about the new watches first. We buy the watches from their manufacturers or their subsidiaries, which offer these watches, and there we get a range of margin. It depends on the brand and conditions and so on and so forth. We have an overall margin of about 28% plus. Now, on the pre-owned watches, it's a different proposition, because there are some brands that are more in demand and where prices hold steadier. In some cases, prices even increase as with time. These are what are called collectible watches, and a lot depends on the condition of the watch, the age of the watch, and what demand for the watch among collectors and who want watches. But typically, I can say that after including, after blending in all of this, the overall margin that we make on pre-owned watches, as of now, it's not very different from the margin that we make on new watches. So we don't see a great change in margin structures going forward between these. However, I do want to say that in the pre-owned watches, we are already working at a much lower inventory than we are in the business of new watches. And going forward too, we believe that the inventory requirement in pre-owned watches will be less. Why is that? Because in pre-owned watches, we have one lounge currently, one physical lounge, and we will open another one soon. But essentially, the business will be digitally enabled. So there is a website which lists all the watches which are offered. There are going to be a couple of lounges, but it's not going to be like a physical store network where we currently have 50 stores. And that's why, from a working capital point of view, it will be much more efficient.
Let's take this point further with Mr. Agrawal. Mr. Agrawal, from a fund usage perspective, as you get funds from this IPO, and when I compare that to a working capital requirement, if the revenue growth or the revenue proportional growth is same like what we have seen over the last few months, the working capital requirements will also grow in a similar proportion. So help us understand if you're going to need further working capital funding, or how is the overall requirement looking like?
Sure. So, for a utilization of fund, that's the first question. So mainly, we are looking into for a growth capital of the organization. The utilization will go on capex of a new 13 new store that we have planned during the year, retirement of the debts that we have planned, upgradation of technology platform that we have, and working capital requirement, as we have mentioned, we have a growth capital and our general corporate purpose. On the second piece, where you mentioned about more working capital, what we believe currently, looking into the growth proposition that we have, we do not foresee that we will need any further fundraise.
Do you believe that margins are going to be sustainable, because the valuation at top end, at the top price band, which you have ascribed to, if that is being asked, the investors are going to demand premium margins here. So are the margins sustainable?
Definitely, we believe. Definitely, we believe so. And why we believe so is the strategy and the stepping stone that we have built, and the revenue. So basically, what is if we talk about from a P&L structure, there is a variable cost and there is a fixed cost. So the leverage that we get is on the fixed cost that is there, and that there is a headroom that we will gain more margin. And this is definitely a sustainable. What we have seen is the growth in revenue, and that actually is resulting on the margin.
Piyush, if you
Right,
allow me a minute, I just want to again comment on this. While you see the sharp changes, we have to factor in the COVID impact over the last, let's say, 8 to 10 quarters. The last quarter of FY20 and the first 2 quarters of FY21, right? These were severely impacted by COVID. Then we had a recovery in the second half of FY21. And if you would analyze this quarter on quarter, and then coming to FY22, where the first half was impacted, we have the 6-month results, but you have the 9-month results as well. And separating these out, you will see a very sharp improvement in quarter 3. Quarter 3 of FY22 is the real post-COVID trend, which we believe is the post-COVID trend. And we are pretty confident that this is the kind of structure that's going to stay. And further, as Ritesh mentioned, as revenues grow and we get leverage on fixed costs, we believe that the margins can improve overall.
Well, that answer brings us to the end of the show. Mr. Sabu and Mr. Agrawal, thanks a lot for joining us on the show and helping our viewers understand the business model and also the future prospects for Ethos Limited. With that, it's a wrap on this show. Hope you enjoyed the show.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICIdirect.